We got another very important video today that's going to explain where the stock market is going over the next few years and why. There have been a few critical changes to our market structure that most people are missing. And you're going to see why it's going to be a tricky balancing act between a massive bull market, one so big like we've never seen before, but also an equivalent bear market and crash. It's a double-edged sword. So after you watch this video, you're going to be way ahead everyone else in terms of understanding what's going on and even more importantly, how to play it. The goal is always to grow our money as fast as possible, but also to protect it. A lot of people forget about that second part. So let's jump into what you need to know. And of course, this is coming straight from our research at Macro Ops. And this stuff in particular is pretty advanced, but stick with me here because it's going to be worth it. But first, let's take you back to March, the beautiful pandemic. And what did we see happen? We saw the market collapse and rebound so quickly that everyone was scratching their heads. You can see some of the headlines from back then. It's a little blurry, but you get the general gist. This market makes no sense. Stocks soar despite coronavirus and recession. It's time for a reality check and a crash. And all in all, is people wondering, why would stocks soar despite a coronavirus and recession? Clearly, it didn't make sense and it should end in tears. But actually, it does make sense. It makes complete sense why the market rebounded like this and is now on a massive tear. Huge bull. And the reason why it makes sense is because of fiscal policy. Now, when I say fiscal policy, I mean what the government is doing. You have monetary policy, which is what the Fed is doing, and then fiscal, which is the government. So monetary is the Fed printing money, and fiscal would be like these stimulus checks that we're all getting. And also any laws that the government can put into place, like tax breaks. So there are two sides to the system. And what did we see? That CARES Act passed, right? $2.2 trillion in aid. Massive fiscal package, one of the largest in history. So here's the thing about fiscal stimulus. It is the ultimate cheat code. It can solve all your problems, at least for a time. It is strong evidence in the case that money does buy happiness. But you're going to see in this video why fiscal is going to be such a big driver of everything going forward. So of course, we're going to go over exactly what this means. But before that Dem sweep in Georgia, that basically gave Democrats, who are coming into power right now, obviously, it gave them the power to run their own fiscal policy however they want, which, as you'll see in a second, very good for markets. Now, another concept to go over real quick is the idea of an upside down market. And what's that? Well, it's the concept that every time there's bad news about the economy, for some reason, the stock market shoots up. And the March example pretty much fits into that because we had massive closures, a rampant disease, but somehow the market just shot straight up. And even the last 10 years, it's always been bad news is good because they stimulate and that sends stocks higher. So knowing that concept, let's consider an extreme scenario. And this one is coming from a guy named Jesse Livermore, and he's not the actual Jesse Livermore, obviously, but that's his code name on Twitter, and he works for O'Shaughnessy Asset Management now. So he put together a whole paper about this concept that we're talking about. And in this example, this extreme example, let's say that the government, with the support of the Fed, decide to set a 5% nominal growth target for the US economy. That means they want everything growing at 5% a year no matter what. Doesn't matter if there's a virus or anything like that. And suppose under this policy regime where they want that growth no matter what, the economy gets hit with a virus. But this virus is even worse than the CCPV because it doesn't just last for several months, but it lasts forever. So all of us are separated forever. No one can talk to anyone anymore. We all just watch YouTube videos all day for just some form of connection. Well, obviously this would be devastating for an economy, right? Massive layoffs, tons of businesses shutting down. So how is the government going to reach their 5% no matter what? Well, what they do is inject massive amounts of fiscal stimulus. They inject as much as they need to hit that 5%. And of course, because they work with the Fed would help by cutting interest rates to zero or maybe even negative. So if that's the case, what happens to the stock market? Well, because interest rates are so low or even negative, stocks become way more attractive than holding cash or even bonds. Because your return on cash and bonds is based off the interest rate. So if the interest rate is higher, what happens is that more people see this safer asset and they want to pile into it versus stocks, which are considered more risky. But if these safer assets aren't yielding anything, you're not making any money by putting it there. In fact, you might be losing money. Then you're going to go into the more risky asset, which is stocks, because they're giving the return. So if the Fed cuts to zero or negative, then yeah, these things suck. Let's jump into stocks. And then on top of that, because this virus is so bad, this super virus, corporations are making cuts left and right. They could get rid of their workforce like that because they have the cover. Just like so many people got laid off in 2008. Reason that happened is because they had the 2008 financial crisis as cover. You just can't fire people. It doesn't go over well, especially large amounts of people. You need that reason to blame it on. So when these corporations fire all these people, what happens is that they unlock productivity in their companies. They basically get synergies, cut costs, things like that, so you could see the bottom line improve. Now, normally, any bottom line improvement there is offset by all these people that got fired. Because how do consumers buy your product if you're a company? Well, they go work at a job and that job pays them money, right? So if all these companies are laying everyone off, then these people just lost their source of income. How are they even going to buy the product that you're producing? So when you lay off a bunch of people, it comes back to bite you in the ass later. But in this case, if you have massive fiscal stimulus, then these companies can lay everyone off because the government will just take care of them. And those people will get the money from the government that they could use on their products that the company's selling. And it's just fine. So the company wins out. They get to cut their costs so their profitability is higher and all the demand stays the same because these people are getting supported from a different source. So you can see what happens here in this scenario and why it causes stocks to go up. So we have economic weakness that leads to fiscal expansion, the government stepping in, which leads to higher earnings for these companies because even as they cut costs, all those employees that they let go, they're still getting money to buy stuff. And on the monetary side, which is the Federal Reserve cutting those interest rates, we get lower interest rates, so more people interested in stocks. And we get a greater supply of cash and bonds, which we're going to talk about now. But even with this much information, everyone forced to pile into stocks because lower interest rates and all the companies in the stock market are posting better profits. Two big factors send stocks much higher. Now this is an extreme scenario, right? With the master virus, the worst thing possible. But honestly, our current environment of what's happening isn't too dissimilar. That's why we could have a bunch of people try to storm the Capitol and the SPX catches a strong bid anyway. Who cares? Storm away all you want. We're still going to be buying stocks. So that's the big thing here. Fiscal stimulus is a cheat code. If applied in sufficient amounts, it can and will override all other concerns. Money solves everything. It's like the opposite of a Disney movie. We don't need love, we need money. Now here's the thing, as we all know and we talked about before, when the government is giving out checks, what's happening with those checks? They seem to be going straight into the stock market. But now if we think about it, we could actually break down the mechanism to say that actually any money that is transferred to people from the government will wind up back in financial assets. And the reason for that is because, okay, say you give money to a person who's not investing in the stock market because they're using that for food and other things. Well, when they spend their money at a company, where does that money go to? It goes to pay other people, right? And because in America we have such economic inequality that the people who do have to spend their money on their food and other essentials, when that money goes to the people working at the corporations, that money that they collect from their paycheck goes straight back into the market. So either way, you know, when you get a check, you have a decision what to do with it, right? So we saw a lot of people, instead of paying their rent and buying food, they're putting it into the market. But even the people who are more responsible and use it for the essentials, it still goes back into the market. So what you got to understand is that fiscal injections are market injections. And this goes back to this, what I was saying I would explain before. A greater supply of cash/bonds leads to higher stock prices. And that's because if you give an investor more cash and interest rates are too low to put it in bonds and they have to put it in stocks, that's one reason stocks are going to go up, right? Add in that other reason that corporations are making more profits. Companies look better, people want to buy them more. Then the third reason is once again just back to the cash that you're giving them. If you give someone a 5% increase in the cash that they're holding, and if they're trying to go for, say, a 60-40 asset mix, and this is a very common asset mix, it's 60% stocks, 40% safer assets like cash and bonds. Well, if you give them 5% more cash, then all of a sudden, instead of 60% in equities, they have 55% in equities, and instead of 40% in cash, they have 45% in cash. So just to maintain their asset mix that they had before, they all of a sudden are forced to buy 5% more in stocks. And again, I think this is what, the fifth time I've said it, this is assuming that there are no returns in treasuries and bonds. Cash and bonds return less than nothing. So at the end of the day, there is no alternative, and that's what TINA stands for, if you've ever seen that acronym. Markets are going up because there's nothing else to do with this money. There's nowhere else to put it. Now we can look at markets like bearish investors do and say, hey, there's way too much speculation right now. Rampant. Sentiment is too crazy and people are too invested in the market. This is bearish. And that's true. It is bearish, but it's also only one piece of the puzzle. And you know these are the same metrics that we look at almost every week as well. But if we only look at those metrics, we're missing the bigger picture of what's going on. And that's why I'm making this video. This is the big structural change that ends up outweighing everything else. So what bears tend to miss when they're bearish on the market and just focused on these things is first the fact of all this fiscal spending that's happening and how it goes straight into the market. And also the fact that the normal response that we usually get from interest rates, it's not happening anymore. So normally bonds and stocks compete for capital, and that's what keeps both of them balanced. But if we say that the Fed is holding down interest rates for a long time and they're not letting the regular interest rates play out, then there's no correction happening. All the money is just going straight into stocks. No balance. So the effective governor on the market is broken. And that's the natural governor that makes sure we don't overheat. So again, there's no other alternative than for all that money to flow into stocks. So that's the environment we're in right now out, which is why we're getting rampant speculation. We have all the ingredients to make the wild days of the dot-com bubble look like a modest snooze fest. That's how bad it is. And like I said in the beginning of this video, that Democratic win in Georgia is the best thing that could have happened, because now Biden is going to have a large enough majority to pass big stimulative measures, so really enact that fiscal policy, but the margins are too thin to actually change tax policy. So there's going to be more money flooding out while taxes stay the same. So all of this sounds super, super bullish, right? And of course it is. And that's why in all these videos, I'm always talking about risk control, but at the same time, I'm saying don't become fully bearish for no reason. You shouldn't let your bias influence you and say, oh no, I don't want to invest, or I want to pull out my money or short something. You got to understand that conditions are ripe for a massive bull market that could last another few years, and one that's so big that it's going to make the tech bubble look like nothing. And we've talked about this in previous videos. We already see it happening with all these penny stocks popping off, people making 100% overnight. That's great. Go ahead, play it. But 99% of those investors are going to get wiped out because they weren't looking at the downside and weren't managing their risk. Because this whole bull market that we're talking about, tons of fiscal stimulus, interest rates through the floor, does it just go on forever? No, it does not. It's not like we figured out some magic formula to fix economies so that they never go down ever again. No, that's impossible. And that's why if you're a good investor, you are playing this crazy upside, but you're always looking at the downside too, ready to jump out. It's like if you're in a crowded movie theater and it's going to catch on fire, you want to be the first out of that door, instead of the one thinking that it's never going to end, because those are the guys that get screwed. And like I said, this will end. Like we say here, something will eventually kill this Goldilocks for bullish speculation. And that something is inflation. Now, of course, I'm going to have another video for you explaining that inflation aspect of this. But before we even do that, to understand the full picture of what's going on, you got to dive into what the Fed is doing, because the Fed has completely changed. We talked about it a little bit in this video, but it's more drastic than what I briefly mentioned. So click this video right here where we explain the whole thing. It is manipulation like we've never seen before. And again, it's going to be a massive bull market with a massive crash, and the Fed is going to be a big part of that. Click this video here and you will see what I mean. I'll see you there.